Burung Company. Always read the requirement first. To calculate the adjusted present value of the project, correcting any errors made in present value estimate above, and conclude whether the project should be accepted or not. So it's a 13 marker question, which means that we have to go and solve for the whole part. Okay, we have to solve for the whole part of the APV. Up, whenever you get a question, the very first step that you are supposed to take is what? Sir, I should go and solve my question for base case NPV. Is that correct? Let's read the question first of all. You have recently commenced a working for Burung Company and are reviewing 4-year project which the company recently considering for investment. Sales revenue is given, direct costs are given, interest is given, profit is given, tax is given, investment is given, cash flow discounting factor at 7%. Okay. Net present value is negative 1.65 and therefore the recommendation is that the project should not be accepted. Notes to NPV. Since the real cost of capital is used to discount cash flow, real cost, neither the sales revenue nor the direct project cost have been inflated. It is estimated that the inflation rates applicable are 8% per year and the direct project cost is 4% per year. 1 point. Point number 2. The project will require an initial investment of 38 million. Of this, 16 million relates to plant and machinery, which is expected to be sold for 4 million when the project ceases. Okay. 16% relates to plant and machinery, which can be sold for 4 million after taking any taxation and inflation impact on account. Tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% year after. Thereafter, on a reducing balance basis, which is 50%, 25%, 25%, and 25%. Remember that. Balancing adjustment is available in the year the plant and machinery is sold. Burung Company pays 20% tax on its annual tax payable profit. Either uses a nominal capital of 11% or a real cost of capital 7% to discount, given the rate of inflation has been stable at 4% for the number of years. Interest is given as 150 basis points over a 10% government yield rate. Okay. It is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from subsidized loan scheme run by the government, which lends money at a rate of 100 basis points below 10-year government debt yield rate of 2.5. Yani at what percent? 2.5 minus 0.1. Acha, it's 100 basis, so 1. Issue cost related to raising the finance are 2% of the gross finance required. The remaining 40% will be funded from Burung Company's normal borrowing sources. Okay, that is fine. The debt available to Burung is equal to the actual amount of debt finance raised for the project. Okay. Identified Lintu Company, which operates in the same line of business as that of the project, and it is considering Lintu Company is financed by 40 million shares trading at $3.2 each and 34 billion debt trading at 94 per $100. Equity beta is estimated at 1.5. Yahan se beta we can find out the cost of equity, pure cost of equity without any cost of debt. Step number 1, base case NPV. Right, that is your first step, everyone. We have to go and solve for the base case NPV. Now, just a second. How many years do we have? 4 years. Sales revenue is given from year 1, which is 23.03. But now is this inflation? Is this considering inflation? No, guys, it is not considering inflation. So that will be 23.03 multiplied by what is the rate of inflation? 8%. Now it is considering inflation. Year 2, what is the sales? 36.6. Then year 3, it is 49.07. And then 27.14. So now we have the sales. Cost is inflated at the rate of 4. So minus 13.82 raised multiplied by 1.0. That was 4%, right? 4. 1.04. Then minus 21.96 multiplied by 1. 4 raised to the power 2. If you feel any doubts in any of the part, just ask in the comment box. 29.44 multiplied by 1.08 raised to the power 3 minus 16.8 multiplied by 1.04 raised to the power 4. 19 point 2333. All the points correct. Now can I write down profit? That will be this amount plus this amount, and I can drag it. After this thing, what do we have? We have interest. Do we consider interest, everyone, whenever we talk about this all NPV and APV thing? Do we consider interest? Absolutely not. We do not consider interest because that is taken care in the discounting factor. So there was no use or there was no point to discuss. Okay, so we don't take this thing. So after profit, we have tax. Chalo. Great point. Can we go to the tax? Tax will be how much and at what percent? Is it given? Burung company pays 20% on its annual taxable profit. And it is available in the year. But just a point. Third number we need to read again. Tax level depreciation is available on plant and machine at 50% in the first year, following 25% year after, therefore on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. A Burung company pays 20% on its annual taxable profit. No tax allowable depreciation is available on the remaining. No, okay, got it. Just wanted to know one thing. Tax is paid on that year only, right? Yeah, they are paying tax on that year. So this amount multiplied by what is the tax percentage? 20%. Now we'll also find out the working of tax allowable depreciation. Have they done that? Absolutely not. They have not considered even the tax allowable depreciation, though I'll go and write it down over here. Workings. It will be working 1, which will be of tax allowable depreciation. Tax allowable depreciation is the first mistake that these guys have made, right? So let's go and solve this part of tax allowable depreciation, everyone. Now, when we are going to solve the tax allowable depreciation, do we need to do that? Since it is given that no tax allowable depreciation is available on the remaining assets, Okay, tax allowable depreciation is available for that particular plant and machinery. That is one thing which is being provided to us. We can go and solve for that. Value at start, depreciation, value at end, taxable benefit. Okay, so what is the value at start, everyone? Plant and machinery value is given as 38, out of which 16 million relates to plant and machinery. We'll write down 16. Depreciation on that year will be how much? 50%. That was given over here, 50%. So this multiplied by 50%. 8. Then value at end will be 16 minus 8. Taxable benefit will be on the depreciation, which will be equal to 20%. So that will be the amount of 1.6. Okay. Then what is the value at the end? Over here it was 50%, and after that it is going to be 25%. Correct. This is going to be the amount, but at the end of the project, the value will be equal to 4, because the other value of asset is going to be 0. So this 16 value will remain 4. The depreciation will be this amount minus this amount. This will be the final depreciation, everyone. Now, so I can write down TAD wala benefits, which will be this amount. Sorry, not this amount. This amount, this amount, this amount, and this amount. This is going to be the TAD benefit. Then we'll reach to the net cash flow. Do we have the working capital or anything like that? Absolutely not. So we'll go and type this down. Okay. So profit minus tax plus TAD. Then investment slash scrap. Investment is minus 38. Scrap is equal to 4. Right? 38 and 4. I'll write down over here net profit. Now I'll write down net cash flow. This amount, this amount, plus this. These are my net cash flow, everyone. Now I just need to find out the NPV or present values. Now, can I go and solve the present values directly? What is the discount rate given? Sir, 11% and 7%. Can I use nominal rate? Absolutely not. Why? Because we have to find out pure equity based discount rate. So I'll go to the worksheet number 2. Discount factor. Correct. I need a pure discounting based number. I can do that, everyone. Beta equity. I just need to find out beta asset, which is equal to beta equity, which is how much? 1.5 multiplied by what is the value of equity? Okay, we have to calculate that. Now it is getting interesting. Value of equity, which will be equal to 40 million shares, 40 multiplied by 3.2, and value of debt, which will be equal to 34 million debt. 30, sorry, 34 divided by 100 multiplied by 94, 31.96. So value of equity multiplied by beta equity multiplied by value of equity divided by bracket open value of equity plus another bracket open value of debt multiplied by what is the tax rate, which was 20%, 1 minus t will become 0.8 bracket close. Beta asset is coming out to be 1.25. Now can I go and find out my cost of equity, which will be equal to what? Risk-free rate. But I have just used the formula which I generally use when I solve the beta asset equal to beta equity multiplied by value of equity upon value of debt over here to find out beta asset. Now coming to the cost of equity part, the government yield on the government treasury bill is 2%. So risk-free rate is 2 plus plus market risk premium is 8 multiplied by beta equity, which is 1.25. I'll put this in bracket. So 12% is the cost of equity. I'll directly take 12. So present value I'll put down equal and PV bracket open, put down 12%, comma over here 49. Hence net present value will be equal to this amount plus this amount. 11.58. Now this is my base case NPV, everyone, 11.58. Have we considered the financing effects? Absolutely not. Okay. So if I talk about this formula, this is the only formula that I have used. What is the formula over here? Beta asset is equal to beta equity multiplied by value of equity upon value of debt upon में value of equity plus value of debt bracket में 1 minus tax. Okay, this is something that we will discuss in the further classes as well when it comes to the risk adjusted WACC and all that topic. We'll talk about this topic at that time. Okay. For the time being, it might have not been discussed with you guys, or if you have not studied FM part that effectively, then this might be something new for you. Now let's move to the financing side effects, everyone. So first of all, we have issue cost. Issue cost, is it mentioned? Project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan. Okay, is it given somewhere regarding the issue cost and all? Issue cost related to raising finance are 2% of the gross finance required. Directly it is given as 2%. So we'll take up the whole 38, everyone. So 2 upon 98 multiplied by 30. So this will be my issue cost, 0.77. Direct. Control B. Then we have tax yield on. Just a second, we need to check tax yield as well. Okay, so we will get two tax shields, everyone. One will be from subsidy wala and one will be from the normal one. So now tax shield on, first of all, subsidy interest. So what is the total value of subsidy? First of all, sir, 38 million multiplied by what percent are we getting? Subsidized, 60%. 60%. First part is done. Multiplied by what is the rate of interest? Now, what is the rate of interest? 100 basis point below the 10-year government debt yield rate of 2.5. 2.5 is the general rate that they are getting. 100 basis point below, yani 1.5. So it will become multiplied by 1.5%. Multiplied by. This is the total interest. Now tax on that interest will be equal to 20%. Now we will have the total interest. Now we need to multiply it by the one very important thing over here, which is called as, remember everyone, that is your annuity factor. Annuity factor, we can consider anything over here. Let's take up how many years? 4 years annuity factor for 11%. If you want, real cost of capital is 11%. So we can take nominal cost of capital 11%. That is fine. Interest for 11%. Okay, that is completely fine. You can do that. Any doubts as of now? This question might get a little trickier for you for the time being, but it is still pretty simple. Okay, we are
Could
not.
you explain? Yeah, could you explain this part again, sir? Sorry.
Okay, so
Subsidy interest.
what happened over here? What is the total amount of loan that we are planning? Sir, 38 million. Out of that, 60% we are getting from subsidy multiplied by 60%. Out of that 60%, onto that 60%, we are paying how much? Sir, only 1.5. Why? Because we are paying 100 basis का मतलब होता है 1%. Whatever the basis point divided by 100. So 100 basis point divided by 100 equal to 1%. So 2.5 minus 1%. That will be the basis point that we are supposed to use. Okay. Now we get the total interest. But we are going to save tax on that interest. So how much tax are we paying? Sir, multiplied by 20% and we get the tax percentage. Correct. When we multiply it by 20%, we get the tax percentage. Is that right? Am I clear, everyone? This is what we get when we
Yes.
multiply by 20%. Now, this is the amount that we are going to get for the next number of years, right? Next number of years. So now the question comes in, for how many years should we consider this amount? This is the next question. Should we, how many years is clear? It is going to be 4 years. Now coming to the annuity factor, we have to identify what percentage should we take. Correct. This should be your next question. What percent should we consider? Up when it comes to the interest, over here, if you notice, there are like, just a second. Yeah, there are like number of factors that can be considered. What is the general rate of borrowing? Let's take general rate of borrowing. General rate of borrowing, it is 2.5. No, no, not this, not this one. What is my general borrowing rate? Yeah. Interest is based on normal borrowing rate of 150 basis point over government yield rate. So government yield rate is 2.5 plus 150. That will become 4. So 4% 4-year annuity factor we should consider. 4% 4-year. That will be my borrowing rate, everyone. Okay. So it is equal to 3.63. This amount multiplied by 3.63. So this is the subsidy interest benefit, tax interest. Tax benefit on subsidy. This is 1 point, everyone. Okay. Now, similarly, normal borrowing interest. So that will be equal to 38 multiplied by 40% multiplied by interest is 4% multiplied by 20% multiplied by 3.63. We have all done all this part. The total amount will be equal to this plus this to equal to 6.897. Now, last point, subsidized loan benefit. Last point, subsidized loan benefit everyone. Okay. So what is the subsidized loan benefit that we are taking? We are taking loan of 38 multiplied by 60%. This is the benefit that we are planning. Correct. This amount multiplied by my subsidized loan I am taking at 1.5. My normal rate is 4. So 4 minus 1.5. This is second thing. Correct. I'll put interest inside only. 4% minus 1.5%. This is the net benefit that I am getting. Onto that, I'll point out 20% tax. And then again, I will charge multiplied with the annuity factor 3.63. So 4.431. That will be my net benefit. Okay, great. Sorry, यहाँ पे बेटा we have to use subsidy benefit post interest. So it will be 80%. Subsidy benefit is post interest. We are not getting benefit of tax on subsidy. We have calculated that part. But because we are taking a cheaper loan, how much money we are saving? That we have to calculate post tax. So now it is fine. So now total APV will be equal to 11 plus this. Sorry, issue cost will be negative. Minus this plus tax shield plus subsidized loan benefit. 13.14. That will be the equal amount for the adjusted present value, everyone. I'm opening this whole picture for all of you. If you guys have doubt, can ask.